What can the market stand today, Mr. Belski?
Well, you know what? If anybody can thread the needle, it's Jay Powell. I always like to say that wisdom comes from humility and listening. And I think what happened in the fourth quarter of 2018, when he was obviously on a path to raise interest rates, which he did, versus what President Trump was doing with tariffs, the market didn't like it. And then we quickly pivoted and learned from that and ushered in 2019 in January, a replay and redo of 1995, which really defined Goldilocks. And I think the bond market is telling you what we should be focused on. And the bond market has enjoyed a 40-year bull market. And they've got all the money, and they've been right. And the bond market is worried on the variant, or the variance. And I think this is going to be a defensive move that the Fed cannot ignore. And so I got to tell you, I'm more with Joe. I think there's an upside surprise coming. I think that he could be, Mr. Powell could actually be more dovish. The market will like that. It pushes back the dot plot. But be that as it may, we know that the Fed has to raise rates, and it's going to raise rates. The broader economy continues to improve. We had a little bit of a hiccup here on near-term data. But be that as it may, earnings are improving, the economy is improving longer term, and the Fed has to raise rates from these crisis levels. And oh, by the way, history shows that that's a good thing for the stock market. And in fact, on the technology side, we said it last time, I think, when we were on air, 5 out of the last periods when interest rates went up, technology outperformed. And so we think that the market is in good shape. We think that the market could actually see a bit of a surprise from the Fed today. Right. And I think there's a very good chance the Fed is more dovish than you think.
All right. Now, I got a couple things I need to come at you with based on that. It doesn't surprise me that you think that, or that you would say that, given your target's 5,300 on the S&P for next year. You need to say that. You need that to happen to get to 5,300, whereas Powell, he had a chance to be more dovish on the Hill, and he wasn't. He was there for 2 days. He had a chance to fix what he allegedly did on the first day, and he didn't. That tells you, does it not, that if you're looking for a dovish Fed chair today, you ain't going to get it.
I don't know. I'm not quite sure. You know, our models are what our models are, and our analysis is time-tested, and we continue to be very bullish. As you know, we've had this 20 to 25-year bull market call, and we're going to remain with that. And I like the fact that many of my compatriots are bearish. I like that. I get more worried when everybody's bullish, and that's clearly not the fact. With respect to the Fed, clearly, I believe that they were focused on the headlines with respect to inflation versus what's happened in the economy and in terms of the overall stock market and earnings growth. Scott, I'm not being negative on the Fed. It's not a compromise my situation with respect to the Fed. I just think that they were solely focused on what's happening right now in terms of supply chain, and instead not focused on where the puck is going. And where the puck is going, when you play hockey, you have to do that, by the way. You have to focus on that in sports. And I think you have to see that the economy is improving, and the stock market's improving, and the earnings improving. And so I think that's going to be the notion with respect to what the Fed is going to be positioned. So maybe I'm out there, but I think the Fed, there's a very good chance the Fed could be more dovish than the market is.